Welcome to Sheen Research, your strategic partner in comprehensive investment analysis.
Today, we are undertaking a critical investigation into the fundamental drivers behind Circle Internet Group, Inc., trading under the ticker CRCL.
And our mission today isn't just to read off the numbers from their Q3 2025 10Q filing, which came out November 12th.
No, not at all. The goal is to synthesize that data and really integrate it with the, let's call it chaotic market behavior we've seen recently.
Chaos is the perfect word for it. I mean, if you were watching CRCL's stock chart this quarter, you witnessed a price swing that it just encapsulated the entire crypto market's drama in miniature.
It really did. So for context, Circle went public back on June 5, 2025, with an offering price of $31 per share. And that IPO, by most metrics, was a success. But the market reaction was just explosive.
Absolutely explosive. The stock surged dramatically, hitting a closing high of $263.45 on June 23rd.
And that kind of immediate post-IPO run suggests overwhelming enthusiasm, right? Both retail and institutional. It's a belief that this company was maybe the most critical piece of regulated financial plumbing to hit the public markets in years.
But here's the whiplash moment. Since that high watermark, the momentum completely reversed.
Completely. By the Wednesday, just before November 20th, CRCL hit a record closing low of $69.72.
Do the math on that. That's a staggering 74% decline from its peak in just a few short months. When you see a drop that steep, the natural conclusion is that the underlying business model is fundamentally broken.
And that is precisely what makes the timing of this investigation so crucial. Because here's where the story pivots again.
Right. On Wednesday, November 20th, so the same day or the day right after that record low, Cathie Wood's ARK Invest stepped into the market.
They bought the dip, and they bought it with real conviction.
Over 215,000 shares of Circle, valued at about $15.1 million at the time.
And this wasn't some tentative entry either. They strategically spread this purchase across 3 of their major ETFs. The Flagship Innovation ETF, the FinTech Innovation ETF, and the Next Generation Internet ETF.
So what does that signal to you?
It suggests that a major institutional player believes the fundamental value of Circle is substantially higher than where the market is pricing it. They're making a bet that this multi-month slide is just temporary noise.
And to give that a little more context in the broader crypto equity space, it's worth noting ARK also made a big move into bullish, or BLSH, that same week.
Correct. Bullish shares also closed at an all-time low, hitting $36.56, which is just a hair below its $37 offering price.
And ARK bought how much of that?
Over 460,000 shares of BLSH, valued around $16.9 million. So you see this pattern, strategic buying activity signaling a belief in the long-term potential of these foundational stablecoin and crypto exchange companies, despite their shared recent profound price weakness.
It tells us that these sophisticated investors aren't just looking at the short-term chart. They're focused on the underlying ecosystem health.
Precisely. So our objective for you now is to strip away that market noise, the wild swings from 260 down to 70.
We need to investigate the foundational numbers and qualitative drivers presented in that Q3 report to figure out what truly lies beneath these moves for CRCL.
The central question we have to answer is this. Was that 74% decline justified by their operations? Or is this simply a case of post-IPO exuberance correction colliding with technical financial adjustments that have masked a very, very healthy underlying business?
Okay, let's start answering that central question by looking at the hard numbers. We'll begin with the third quarter, Q3 2025, compared to Q3 2024.
The top-line performance here offers the first real piece of compelling evidence that management was executing even as the stock was cratering.
And the top-line results were certainly compelling. Total revenue and reserve income, they saw robust year-over-year growth, climbing 66%.
Right, so this translates to revenue jumping from about $446 million in Q3 of 24 to nearly $740 million in Q3 of 25.
That level of acceleration, a 2/3 increase in annual revenue, is what high-growth tech companies dream of. It's a very strong operational counter-argument to the stock's performance.
And drilling down into that growth, the narrative is still heavily centered on reserve income. It's so important for you to understand that Circle's core business model is not about generating fees on transactions.
No, it's about generating yield on the massive pool of dollars backing their stablecoin, USDC.
Reserve income is, without a doubt, the primary engine. In Q3, it grew nearly 60%. That's an increase of over $266 million to reach about $711 million.
And the 10Q gives incredible detail on what's driving this, which is essential to understanding the quality of this revenue.
It is. You might assume this massive increase was driven by ever-rising interest rates in the current environment. But the reality is exactly the opposite.
Okay, unpack that yield versus circulation dynamic for us, because that seems incredibly counterintuitive. How could they grow revenue so quickly if yields were actually falling?
The strength here is the sheer power of network effects and adoption. Management attributes approximately $388 million of that reserve income increase to one single factor.
And that is?
A massive 96.1% increase in the average daily USDC in circulation. Circle was carrying nearly double the amount of stablecoins, more dollars in the bank, essentially.
Okay, so a huge increase in the asset base. But what was the offsetting factor?
The crucial offsetting factor, and the report notes this, was a significant offset of about $122 million decrease, which they attribute to a 96 basis point decline in average yields.
So while the underlying financial infrastructure for stablecoins was generating less yield per dollar because of Fed actions or the types of reserves they were holding,
Circle simply scaled the total pool so dramatically that the volume growth completely overwhelmed the yield decline.
so even with central bank actions potentially lowering their return rate per dollar, the underlying utility and network effect of USDC adoption overpowered that headwind.
Exactly. That operational resilience, growing volume faster than the environment can reduce yield, is a very, very strong sign for the long-term viability of the business.
We should also touch on the smaller but maybe strategically important components of revenue. What happened to other revenue?
Other revenue, while it's still small relative to the enormous reserve income, it showed an astronomical percentage increase. It jumped from basically negligible, about $500,000 in Q3 2024, to over $28.5 million in Q3 2025.
And that's not just noise.
No, this diversification, even these smaller figures, it suggests that newer product lines and services, like the fees they're generating from CCTP, the cross-chain transfer protocol, are starting to scale aggressively.
So it hints at a future where Circle isn't just a treasury management company.
But a fee-generating payments infrastructure provider, that's the key.
And looking at the bottom line for Q3 2025 alone, the picture looks very impressive on a standard GAAP basis.
It does. For the quarter alone, before we get into the distorting 9-month figures, the company reported a massive net income of $214 million.
Which is a huge jump from $71 million in Q3 of 2024.
So Q3 itself looks remarkably healthy and highly profitable. If we stop the clock right here, we would say the market's 74% decline was entirely unfounded.
But we can't stop the clock. The 9-month numbers tell a very different story, and this is where that massive one-time stock compensation charge comes into play.
And that charge fundamentally influenced the stock price narrative. So let's look at the 9 months ended September 30, 2025 versus 2024.
On the top line, the ecosystem strength just continues. Total revenue and reserve income grew nearly 60%, hitting almost $2 billion, up from $1.24 billion the prior year.
And reserve income alone contributed about $1.9 billion of that, a 55% increase. The other revenue acceleration was even more dramatic over the longer term.
Up 471%. That's a $60 million increase to hit $73 million. The top line just confirms massive ongoing ecosystem growth.
Yet, despite generating nearly $2 billion in revenue over this 9-month period, the consolidated GAAP result is a huge net loss. This is the figure that often scares away generalist investors who don't read the footnotes.
And that's the crucial headline reversal. It needs careful explanation.
The company recorded a significant consolidated net loss of $202.9 million for the 9 months. And this is a dramatic and scary-sounding reversal from the $152.6 million net income they reported in the same period in 2024.
So you're going from a $152 million profit to a $202 million loss. On the surface, it looks like a disaster.
But as you pointed out, this loss is not an indicator of operational failure. It's almost entirely an accounting artifact related to the IPO. We need to emphasize this point.
Precisely. This substantial loss is almost entirely attributable to a one-time, non-cash, liquidity event-related expense. The explosion in stock-based compensation, or SBC, triggered by the June 2025 IPO.
It's an essential nuance for investors to grasp because it doesn't represent cash leaving the bank to cover operating costs. It represents a mandatory accounting recognition of compensation that was already promised.
So that brings us to management's preferred metric, adjusted EBITDA, which tries to strip out these distorting non-cash items to reflect the core profitability of the business. What does that tell us?
Adjusted EBITDA paints a significantly, and I mean significantly, healthier operational picture. For Q3 2025, adjusted EBITDA was about $166.5 million.
Up substantially from $93.3 million in Q3 2024.
And more importantly, for the 9 months, the figure reached $414.7 million, up from $252.1 million the prior year.
So when you exclude non-cash charges, like that massive stock-based comp and the fair value changes of financial instruments, you see an organization that is scaling its operations efficiently and achieving rapidly accelerating operational profitability.
I have to interject here and play devil's advocate for a moment. Management loves to use adjusted EBITDA, but those SBC charges, even if they are non-cash, they represent real dilution for shareholders.
Right.
Isn't that adjustment glossing over a massive necessary cost of compensating employees that ultimately impacts the value of the shares that ARK just bought?
That is a very fair critique. It goes to the heart of the GAAP versus non-GAAP debate.
And while the SBC charge is a one-time recognition event tied to the IPO vesting, the stock compensation itself represents real value given up by existing shareholders. And it'll be an ongoing cost, albeit hopefully smaller, in the future.
But for analyzing the core monetization model.
For analyzing the ability to generate interest income net of distribution costs, adjusted EBITDA is the cleanest metric. It tells us that for every dollar of USDC adopted, Circle is successfully capturing a significant amount of the reserve yield, and that process is highly profitable and scaling.
So the GAAP loss is a massive technical side effect of going public, representing past compensation promises finally being fulfilled.
But the adjusted EBITDA confirms that the underlying business model, which is generating yield on over $70 billion in reserves, remains robust and is in fact accelerating its operational profits.
So the price drop was not justified by top-line failure or core operational losses.
Not at all. And that leads us perfectly into the engine room, the USDC ecosystem.
Right. For a stablecoin issuer, revenue is just a consequence. The true health is measured by adoption, by volume, and by robust reserve management. The numbers we're about to discuss are the foundational reasons why an investor like ARK sees long-term value here.
The growth metrics in this section are truly staggering. They confirm the source of that exploding reserve income we just covered. These numbers validate the network effects that are so difficult to build but so dominant once they're achieved. So let's start with circulation. The simplest measure of scale. How much growth did USDC see year over year? The scale of expansion is almost unbelievable for a regulated financial instrument. USDC in circulation nearly doubled year over year.
Double?
It reached almost $73.8 billion by September 30, 2025. That's compared to about $35.5 billion just 1 year prior.
And think about what that represents. In 12 months, they effectively onboarded another $38 billion in institutional and retail demand for a digital dollar. That kind of growth emphatically validates the network effects they're always talking about.
And beyond just the total amount in circulation, the volume of minting and redemption is a key indicator of the infrastructure's robustness. How much money is flowing in and out?
So what were those flows like?
They demonstrate monumental operational capacity. During the 9 months ended September 30th, total USDC minted reached a whopping $175 billion. This is offset by $145 billion redeemed.
Resulting in a net circulation increase of nearly $30 billion over those 9 months.
Exactly. And to put $175 billion in minting into perspective, this is not just digital ledger shuffling. This represents vast sums of fiat currency physical dollars entering or leaving traditional banking rails and being processed, verified, and settled.
The volume demonstrates the resilience and efficiency of the banking infrastructure supporting their on- and off-ramps. Processing those flows efficiently without major delays or failures, that's the core value proposition of a regulated stablecoin.
And importantly, the adoption isn't just institutional, it's broadening across individual users. And that's confirmed by a metric they call meaningful wallet expansion.
This is a critical qualitative indicator for the long-term thesis. Meaningful wallets, or MUWs, which they defined as on-chain digital asset wallets holding $10 or more of USDC.
Reached 6.336 million as of Q3 2025. That is a rapid expansion from 3.578 million just 1 year earlier.
So why is that number so important?
It suggests that USDC isn't just a trading vehicle for whales and exchanges. It's being adopted by millions of smaller users globally, likely for utility like cross-border payments, decentralized applications, or just as a stable store of value in volatile markets.
This broad user base creates a sticky platform, which makes it harder for competitors to displace them.
And placing Circle's growth within the global stablecoin context really helps benchmark their success and understand the size of the opportunity.
The context is undeniably bullish for the whole sector.
It is. Circle noted that the total U.S. dollar fiat-backed stablecoin circulation, that's all regulated, dollar-backed competitors, above 100 million reached about 254 billion by September 30th. The entire market segment grew by 59% year over year.
So Circle isn't just stealing market share. It's capitalizing on and driving the rapid expansion of the entire internet financial system. They're riding a macroeconomic trend of global dollarization via digital rails.
Now let's turn to the pillar of safety, reserve management and liquidity. The entire trust model relies on the quality and accessibility of these reserves.
And transparency here is paramount to maintaining that trust.
Absolutely. As of the end of Q3 2025, approximately 87% of all USDC reserves are held in the Circle Reserve Fund, known by the ticker USDXX.
And this fund is managed by BlackRock Advisors, LLC, and custodied by BNY Mellon.
Yes, the balance held in this specific fund was $64.2 billion, up significantly from $37.5 billion at the end of last year.
So the reliance on a money market fund managed by a traditional finance behemoth like BlackRock is the central guarantee of their reserve structure. This moves the risk profile from crypto counterparty risk to traditional institutional risk.
Which for many large investors is much more palatable. It defines their commitment to regulation and stability.
We also noted that the quarterly average reserve return rate for Q3 was 4.15%.
Which is down slightly from 5.11% in Q3 2024. This confirms that falling yield environment we analyzed earlier, and it demonstrates why volume growth was so critical to their revenue success this period.
And how does the balance sheet perfectly reflect this massive influx of reserves, maintaining that one-for-one backing promise?
It has to balance perfectly, otherwise the stablecoin mechanism fails the trust test. The corresponding liability on their balance sheet, deposits from stablecoin holders, increased by $29.5 billion, or about 68%, to over $73.2 billion.
And this increase is mirrored almost exactly by the asset side.
Yes, segregated cash reserves increased by 67.1%, reaching over $73.3 billion. The balance sheet confirms the one-for-one backing mechanism is operating effectively at massive scale. It shows high integrity in their financial reporting.
Okay, finally, let's look at their own corporate liquidity. They raised a substantial amount of capital this year, as we noted in the intro.
They capitalized beautifully on that early stock surge. Total corporate liquidity, which includes cash and equivalents and segregated cash for corporate-held stablecoins, increased a staggering 109% to over $2.18 billion.
And this increase was primarily driven by the $1 billion in net proceeds from the June IPO and the subsequent follow-on offering in August.
Right. This cash cushion is vital for investing in new products, making strategic acquisitions, and weathering any potential market turbulence.
And specifically, the USDC they hold internally for operating expenses and strategic use also grew.
It did, from about $295 million at the end of 24 to $837 million by Q3 25. This highlights that USDC isn't just a customer product, but an integral part of their own corporate treasury strategy.
We've established that the revenue and adoption story is extraordinarily strong. Now we have to dissect the cost side, particularly the expense structure that determines their profitability, and critically, how the cost of distribution is managed.
Distribution costs are the necessary toll they have to pay to grow circulation, and they are substantial. Total distribution and transaction costs increased 73.7% in Q3.
Reaching nearly $448 million, and almost 70% for the 9-month period, hitting $1.2 billion. That growth rate is higher than their revenue growth rate, which requires some scrutiny.
And that 9-month cost increase is heavily influenced by their key partners, specifically the collaboration agreement with Coinbase.
Can you break down the scale of payments to Coinbase?
The cost increase for the 9 months was overwhelmingly driven by their long-standing strategic relationship. They saw a $301.7 million increase in distribution costs paid directly to Coinbase. They also had a large $190.7 million increase in other distribution costs related to new strategic partnerships. So they are widening their distribution moat.
And the total 9-month distribution cost related to Coinbase alone.
Almost $990 million compared to $687 million in the prior year period.
This high cost structure is tied directly to that collaboration agreement, which is critical for you to understand. The core idea is that Circle shares the reserve income generated by USDC, and the share depends on where the USDC is held.
That's right. The agreement is complex, but it works like this. First, they calculate a payment base, which is the daily reserve income minus management fees and expenses.
Okay.
From that base, Circle retains an issuer retention portion, their non-negotiable slice. Then, Circle and Coinbase each get a percentage based on the amount of USDC held on their respective platforms.
And finally, Coinbase receives 50% of the residual payment base, the leftover profit pool.
Correct. This arrangement means the cost of growth is shared. But the key factor in improving Circle's own profitability is shifting the percentage of USDC held onto Circle's own platform.
Exactly. The higher the percentage of USDC held on Circle's platform, the more reserve income Circle retains directly, which optimizes their share of the profit pool.
And the 10Q provides a valuable breakdown showing that management execution is successfully shifting this balance.
So as of September 30, 2025, what does that breakdown show?
It shows a structural improvement for Circle. Circle's own platform holdings rose significantly to 14%.
Up dramatically from just 2% a year prior.
Coinbase's platform share remained relatively stable at 24%. But crucially, the segment held outside both platforms, the vast majority dropped from 75% to 62%.
So that shift of 12 percentage points from the outside into Circle's own platform is structurally favorable and directly improves their future retained reserve income share.
That is management execution at its finest.
Now for the biggest cost driver in the 9-month period, which is the source of that scary GAAP loss. Operating expenses, dominated by stock-based compensation. This single item explains the entire stock market fear narrative.
The numbers are genuinely shocking in scale. Compensation expenses, salaries, wages, and stock grants increased by over $500 million.
About $514 million, or 265% for the 9 months.
And the overwhelming factor here was an almost $500 million charge, a $467.8 million increase in stock-based compensation.
For the listener who might be overwhelmed by that number, let's explain exactly what triggered that massive one-time non-cash expense.
It was entirely linked to the June 2025 initial public offering. Before the IPO, many restricted stock units, or RSUs, granted to employees had already met the necessary service condition, meaning the employee had stayed at the company long enough.
But their vesting was contingent upon something else.
A liquidity event-related performance condition, the company going public. The IPO met that condition, forcing Circle's accountants to recognize $467.8 million of expense all at once.
Which is why, despite the massive loss, we aren't seeing stories about mass layoffs or operational panic. The business didn't suddenly become $467 million less profitable from core operations.
They just had to pay the piper, accounting-wise, for past promises.
I think it's important to pause and reiterate that while this is non-cash, it represents significant recognized dilution for shareholders. This expense is a critical factor in understanding the post-IPO valuation decline, because the market had to absorb this sudden realization of value transferred to employees.
Precisely. It's a technical adjustment that has real economic impact via dilution.
Aside from that huge SBC charge, were there other significant, albeit smaller, increases in compensation costs?
Yes, reflecting the need to scale up operations to match the USDC growth. There was a $29.5 million increase in salaries and wages due to increased headcount. They are hiring rapidly.
And a $15.1 million increase in payroll taxes.
Primarily related to the RSU vesting, as the employees cashed out those newly vested shares.
And looking at other operational overhead, what about infrastructure investment and amortization? Are they building out their technology aggressively?
Depreciation and amortization, or D&A, expenses increased by $13.7 million, or about 37%, for the 9 months. And this was primarily due to a $14.7 million increase in the amortization of internally developed software.
Which is a very healthy signal. It shows they're aggressively capitalizing and amortizing significant investments in their underlying tech infrastructure.
Like the new payment protocols we'll discuss shortly. They are betting substantial resources on the future utility of the platform.
And their marketing push, how aggressive was their external spend during Q3?
Marketing expenses saw a smaller, targeted increase of $1.2 million, or about 28%, in Q3. This was driven mainly by a $1.6 million increased spending on advertising, marketing, and conferences,
So they're clearly focused on increasing global awareness and distribution.
which aligns with their desire to shift more circulation onto their own platform, increasing their profitability. It's a strategic rather than a scattergun marketing spend.
The Q3 period was defined by massive operational growth and equally significant corporate events stemming from the IPO process itself. We need to break down the financing events that reshape the balance sheet and the products that define their future.
The initial public offering in June 2025 was the foundational event that changed everything, financially and organizationally.
Indeed, the IPO involved issuing 19.9 million shares of Class A, common stock at $31 per share, generating net proceeds of $583 million after fees.
And that influx of capital immediately boosted their corporate liquidity, enabling the operational scaling we've observed.
And they quickly followed that up with a massive secondary offering in August, capitalizing on that early share price surge.
Yes, it was opportunistic and highly successful. A follow-on offering in August issued 3.5 million shares of Class A common stock at a much higher price point, $130 per share.
Resulting in over $440 million in net proceeds.
Combined, the IPO and follow-on offering injected a massive $1 billion in net proceeds directly into the company's corporate coffers. This is dry powder for growth, acquisitions, and stability.
The IPO also fundamentally changed the equity structure regarding their existing debt and preferred shares, cleaning up the balance sheet.
That's correct. In connection with the IPO, 139.8 million shares of redeemable convertible preferred stock, which had an aggregate liquidation preference of $1.1 billion, automatically converted into Class A common stock,
So that eliminated a significant liability segment and simplified the capital structure.
making the company much easier for public investors to analyze.
We must also address the planned insider selling, the Rule 10b5-1 plans, which often draws investor scrutiny right after a public offering, especially given the stock's volatility.
It's a necessary topic. Rule 10b5-1 plans allow company insiders to set up automated trading schedules to sell a predetermined number of shares at predetermined times.
And this is done to manage risk and provide personal liquidity without being accused of trading on material non-public information.
Exactly. Key executives, including CEO Jeremy Allaire, CFO Jeremy Foxkeen, and President Heath Tarbert, all adopted or amended these plans in August 2025. This activity signals anticipated insider selling post-IPO.
And while it can sometimes be misinterpreted as a lack of confidence,
In this context, it's a standard plan mechanism for cashing out some of the equity gained during the IPO event.
let's discuss the change in the fair value of their outstanding convertible debt. This number also moved dramatically due to that stock price volatility we mentioned earlier.
The fair value of their outstanding convertible notes increased dramatically, from just $40.7 million at the end of last year to $149.1 million as of September 30th.
This $108 million increase was primarily due to the sharp rise in the price of the Class A common stock during the 9-month period.
Right. Since convertible debt often has a valuation tied to the underlying stock, the stock price run-up dramatically increased the liability on their books, classifying it as a current liability.
And as a subsequent event, we should note that some of this debt was already converted post-Q3.
In October 2025, $11 million in principal and accrued interest was converted into about 675,000 shares of Class A common stock. This is just another step in cleaning up legacy liabilities and simplifying the structure.
Beyond financing, Circle made a strategic acquisition in the quarter to bolster its product offerings, specifically acquiring Hashnote.
They paid $100.1 million in total consideration for Hashnote. It consisted of $10.2 million in cash and about 2.9 million shares of Class A common stock.
And the breakdown of what they bought is key.
It is. $96.8 million was recorded as goodwill, reflecting the value of Hashnote's workforce and expected synergies. The idea that the combined company is worth more than the sum of its parts.
And they also recognized $4.5 million in identifiable intangible assets.
Split between developed technology and customer relationships, both assigned a 2-year useful life. This acquisition suggests they're really focused on enhancing their treasury, or institutional services capabilities.
Okay, now let's talk about product development, because the true health of Circle often lies in its ability to build new, sticky, and high-utility network infrastructure.
CCTP, the cross-chain transfer protocol, remains central to their cross-chain strategy. This is their solution to fragmented stablecoin liquidity across different blockchains. CCTP v2 launched in early 2025 with a fast transfer feature that generates revenue.
Contributing to that other revenue line item we discussed.
Exactly.
So what is the operational impact of CCTP? Why should investors care about this protocol?
Investors should care because CCTP is essential to maintaining USDC dominance. As of September 30th, CCTP v1 and v2 enabled 380 routes and handled approximately $88.8 billion in transfers.
And in Q3 2025 alone,
CCTP accounted for nearly 50% of all bridged volume across major bridge providers. This is a staggering level of dominance.
50% market share. That means that when users need to move a large sum of USDC securely and reliably between different ecosystems, say from Ethereum to Solana, they are overwhelmingly choosing Circle's protocol.
This reduces fragmentation, it adds a layer of security over competing bridge methods, and it strategically positions Circle as the indispensable financial infrastructure for the multi-chain future.
They also launched a new payment network designed to be fundamentally different from traditional card rails, which they call the Circle Payments Network.
The Circle Payments Network, or CPN, announced in April 2025, is their bid to move beyond crypto trading and into global real-world finance. CPN aims to connect financial institutions, traditional banks, neobanks, and VASPs to enable real-time settlement of cross-border payments using regulated stablecoins.
And crucially, management stressed that CPN is designed as an open system for third-party plugins,
which is a direct contrast to closed systems like the Visa or MasterCard networks. The fact that they already have a trade receivable credit module launching as a third-party application on CPN suggests they're building an ecosystem, not just a service.
And demonstrating their long-term infrastructure bet, they also announced a new Layer 1 blockchain entirely separate from the USDC issuance process.
In August 2025, they introduced the ARK blockchain. It's an open Layer 1 specifically engineered for enterprise adoption. This signifies a push beyond mere stablecoin issuance into core blockchain infrastructure tailored for large-scale corporate use cases.
Suggesting they want to capture the transactional value of enterprise digital asset activity, not just the reserve yield.
Precisely. And finally, we have to mention their EURC stablecoin operations in Europe, a necessary compliance move for international expansion.
Right. Circle Internet Financial Europe SAS achieved full compliance with MiCAR, the Markets in Crypto Assets Regulation, in July 2024.
And MiCAR sets a comprehensive, harmonized framework across the entire EU. This compliance is critical. It positions EURC for regulated growth in that massive European market, and it signals their seriousness about being a globally regulated issuer, not just a U.S.-focused entity.
We've established that the operational metrics are phenomenal, with robust growth, strong product development, and accelerating operational profits. But CRCL operates within a high-risk, rapidly evolving industry. We must now turn our attention to the specific, persistent risks they face that may justify the market's skepticism.
The competition is multi-layered, but one major challenge stems from the rise of yield-bearing assets. This is the opportunity cost of holding USDC.
A profound threat in the current environment.
It is. Yield-bearing assets include products like Treasury money market funds or synthetic dollars that pay interest directly to the holder. Unlike USDC, which is non-yield-bearing to the user, the yield goes to the Circle. These assets offer a return.
And why are these yield-bearing products a particular threat right now, given the overall macroeconomic picture?
The current high interest rate environment amplifies the opportunity cost exponentially. If you can hold an equivalent dollar asset that pays, say, 5% interest, the demand for a zero-interest USDC for simple storage might decline.
So it could cannibalize their market share.
It could. Circle's management has to respond by either launching their own yield products or ensuring that USDC's utility, its speed, reliability, and security outweighs the 5% return users are foregoing.
Then there's the systemic contagion risk, primarily related to their largest unregulated competitor, USDT or Tether.
Circle is inherently sensitive to the stability of competitors, even though USDC is fully reserved and regulated. If there were negative developments, say, regulatory action or a dramatic run on USDT, it could cause a loss of trust across the entire stablecoin market.
Which could lead to a sudden spike in redemption demands for Circle.
potentially testing their operational capacity to honor redemptions simultaneously, despite having the reserves. Conversely, a major failure by Tether could cause massive inflows into USDC, creating its own set of logistical challenges.
And while regulatory clarity is generally positive, the passage of the Genius Act creates a different kind of competitive pressure. Competition from the traditional financial giants.
The Genius Act, which aims to establish a clear legal framework for stablecoins, is positive for long-term stability and investor confidence. However, the risk is that this regulatory clarity acts as an invitation.
It encourages well-established traditional banks to enter the stablecoin industry.
Exactly. Banks with superior financial infrastructures, massive balance sheets, and existing customer bases. These behemoths could potentially cannibalize CRCL's growth by offering stablecoins attached directly to bank accounts, intensifying competition at the highest level.
Shifting to financial risk, the concentration of CRCL's revenue makes it incredibly exposed to Federal Reserve decisions. This is the single biggest operational vulnerability.
This is the central vulnerability, full stop. Reserve income accounted for an overwhelming 96.3% of total revenue for the 9 months.
So their exposure to interest rate fluctuations is immense. It turns Circle, in effect, into a levered high-growth treasury management firm.
And management provided detailed hypothetical modeling in the 10Q to illustrate this exposure, assuming stable USDC circulation for the next 12 months. We need to dissect these sensitivity figures. They showcase the wild swings possible.
So based on the average yield of 4.1% on September 30th, let's look at the forward impact of rate movements. If rates were to increase by a substantial 200 basis points.
That's 2%. The estimated change in reserve income would be a massive gain of $1.48 billion.
But their distribution costs, which are tied to that income, would also increase by about $750 million.
So the net benefit is still significant, but the opposite scenario is the massive risk.
Right. If rates were to decline by 200 basis points.
Circle estimates a loss of $1.48 billion in reserve income, alongside a corresponding reduction of $750 million in distribution costs.
That hypothetical swing of nearly $3 billion in gross revenue over 12 months, based purely on Fed rate movement and not adoption, that showcases the profound, almost binary sensitivity of the business model.
It absolutely explains why the stock might be priced as highly speculative. If the Fed cuts rates rapidly, Circle's primary revenue stream gets slashed.
However, management did add a crucial caveat to this modeling. They acknowledge that the model is only a starting point.
They noted that the relationship between interest rates and USDC circulation is complex, uncertain, and currently unproven. The assumption of stable USDC circulation in the model is unlikely to hold true in real life.
They argue that an interest rate increase doesn't necessarily cause a decrease in USDC circulation because of its utility as a means of exchange.
Right, it's a transactional currency, which separates it from typical savings vehicles. But if rates fall to zero, the incentive to hold USDC for yield purposes drops, though its utility for payments remains.
Okay, finally, let's address the systemic and counterparty risks associated with their operational model. The concentration of reserves in two massive traditional finance firms is a major factor.
With 87% of reserves held in the Circle Reserve Fund, they are exposed to the risks associated with the manager, BlackRock, and the custodian, BNY Mellon.
If either suffers negative publicity or damage to its reputation, or, more critically, if the market for the short-dated U.S. government obligations in the fund became illiquid.
During a sudden, simultaneous wave of redemption requests, it could lead to redemption delays, or, in extreme cases, the reserves being temporarily insufficient.
And the reliance on traditional banks to hold the remaining cash is also a point of systemic risk, given the regulatory environment.
They rely on traditional banks, primarily global systemically important banks, or GSIBs, to hold the remaining cash balances. Increased regulatory pressure on banks dealing with digital asset firms could threaten these relationships.
The debanking risk.
Yes, hindering Circle's ability to access reserves and honor redemptions quickly. This reliance on the traditional financial system is a foundational stability mechanism, but it is also a potential point of failure.
We also have to mention the ongoing compliance and tax uncertainties that require significant investment, especially in the U.S.
The regulatory landscape is constantly shifting, imposing significant compliance burdens. Specifically, the Infrastructure Investment and Jobs Act, or IIJA, imposes new broker reporting requirements for digital asset transactions.
And while there's transitional relief, The rules and their application remain highly uncertain.
creating immediate compliance burdens for Circle and future uncertainty for its customers.
And one final detail that often gets overlooked, foreign currency risk, given their EURC stablecoin.
Right. Circle earns interest in both USD and EUR, but its operating expenses are primarily USD denominated. Fluctuations in the USD-EUR exchange rates could affect their financial results.
And importantly, Circle does not currently engage in hedging transactions to limit this exposure.
It's a deliberate, unmitigated foreign currency risk that will grow in importance as EURC scales.
This investigation has provided a clear and compelling picture. We set out to answer whether that 74% stock price drop was justified by operational failure. And the answer, based on the Q3 2025 filing, is a resounding no, but the market risks are profound.
To synthesize the core findings for you, the massive top-line growth and operational metrics, total revenue up 59% for the 9 months, USDC circulation nearly doubling to almost 74 billion, rapid growth in meaningful wallets, it all shows tremendous underlying ecosystem expansion.
And strategic execution is robust, validated by CCTP's 50% market share of bridged volume and the successful $1 billion fundraise. This operational strength strongly supports the view of strategic investors like ARK, who believe the months-long slide is temporary.
However, this strength is entirely overshadowed on the GAAP statement by that massive $202.9 million consolidated net loss for the 9 months.
And critically, this loss is driven almost entirely by the $467.8 million non-cash charge for IPO-related stock compensation. Operationally, the core reserve management business is highly profitable, confirmed by the adjusted EBITDA of $414.7 million for 9 months.
The persistent risks are substantial and must be managed. Circle is highly exposed to interest rate fluctuations, with over 96% of its revenue concentrated in reserve income, leading to potential swings of billions in projected revenue.
They face competitive pressure from yield-bearing assets and contagion risk from instability in competitors.
And finally, the regulatory uncertainty and dependence on major traditional financial counterparties, BlackRock and BNY, holding 87% of the reserves remain systemic factors impacting the investment thesis.
And that leads us to a final provocative thought for you to consider.
Given that 87% of USDC reserves are held in the Circle Reserve Fund, managed by BlackRock, how does this reliance on a traditional financial giant fundamentally change the risk profile and perception of decentralization for the world's largest regulated payment stablecoin?
Is Circle truly building a decentralized financial infrastructure, or is it fundamentally building a digital front end for Wall Street's Treasury management services? Think about that tension between stability guaranteed by traditional finance infrastructure versus the ethos of decentralized finance.
With that, we conclude our coverage for this video. Thanks for joining us. Sheen Research. Mindful markets, measurable meaning.